to get to after the presentation. Also, we will be posting our presentation to our website afterwards, and we'll also be emailing the PowerPoint deck to all the participants. So with that being said, I'd like to introduce today's presenter, which is Jared Frost. Jared is a tax partner here at Richey May and has been with us as a partner since 2009. He's got 13 years in the industry and specializes in providing tax compliance and consulting services to mortgage banking companies throughout the United States. So with that being said, I'll turn it over to Jared, and thanks everyone.
All right, thanks Kurt. Welcome everyone. We're excited to present on this topic today. We're glad you could all join us, and I hope you will find what we have to share with you today valuable. Hopefully you guys can all hear me. If not, feel free to send an email to Killian Wade. I think and he'll be able to help us hopefully sort through any technical issues. With that said, we'll go ahead and get started. So as Kurt mentioned, I'm Jared Frost. I'm a partner here at the firm. He said I've been a partner since 2009. I've actually been with the firm since 2009. I've been a partner since 2013. And today's topic, as you are all aware, is on the tax treatment of mortgage servicing rights. Our typical little disclaimers about this being only for educational purposes and obviously does not address any specific situations. So to the extent that you want guidance on any specific situation that you might be dealing with, we always recommend consulting appropriate professionals to help address any specific situation. So quickly go through today's topics. First, we'll talk about some tax terminology, what we refer to as normal versus excess servicing, and include the safe harbors in that, so more clarity around what those terms mean from a tax perspective. Then we'll talk about the timing of recognition of income and resulting book tax differences related to having MSRs. When do you recognize that income? What book tax differences result from holding MSRs? Third, we'll talk about the possible tax method change that's available to taxpayers. So if you're currently on a specific method for how you're treating MSRs that's inconsistent with how they can be treated from a tax perspective, there's an opportunity to ask the IRS to change your method. And so I'll just go through that quickly because that's likely not applicable to many of you on the call, but just wanted you to be aware of it. And then last, we'll talk probably about what most people are on this call to learn about, which is the bulk sale of mortgage servicing rights and some of the potential tax benefits that might be in play when you're looking to sell your MSRs. So as I mentioned, we'll first kind of talk about normal versus excess servicing. So normal servicing is defined in the tax literature, specifically in Revenue Ruling 91-46, as rights to receive reasonable compensation for services to be performed under the mortgage servicing contract. So what that's really getting at is obviously in holding these MSRs, you are providing services on behalf of the investor. And the investor is giving you a portion of the interest payments as compensation for that. So on a conventional loan, for example, you might get 25 basis points as a fee for providing the services under the mortgage servicing contract. And to the extent that that fee that you are getting is considered reasonable compensation for the services you're providing, then you have what we refer to from a tax perspective as normal servicing. And we'll kind of talk a little bit about how that normal servicing will get treated from a tax perspective. There are some safe harbors in play here with respect to normal servicing. So it's this concept of reasonable compensation is a little bit gray in the literature. There's not any real specific guidance about what would be considered reasonable compensation. And so that, was frustrating to taxpayers. So the IRS did come out with some safe harbors as to what they would consider reasonable compensation under these rules. And so you can see them outlined right there. For a conventional fixed rate mortgage, it's 25 basis points. For any mortgage that's insured or guaranteed by the government, so FHA, VA, Farmers Home Administration, you get 44 basis points as a safe harbor there. And then for all other mortgages, so that would be like jumbos, ARMs, those types of things, it's 37.5 basis points. These safe harbors only apply to 1 to 4 unit residential mortgages, and taxpayers actually must elect to use the safe harbor. So if you choose not to elect to use the safe harbor, then it's just contingent upon the taxpayer to demonstrate to the IRS that the rates you're receiving are normal servicing if you're treating them as normal servicing. So just as an example, if you were to get, let's say, 30 basis points on a conventional mortgage, the IRS safe harbor is 25, so probably at first glance the IRS would say you have 5 basis points of excess servicing, but if you're trying to argue that 30 basis points actually is reasonable compensation for that particular loan, you would have the ability to do that if you did not elect the safe harbor, and then it would just be, contingent upon you to demonstrate to the IRS why 30 is reasonable compensation given the facts and circumstances of that particular loan. So that's normal servicing. Let's move on to excess servicing. And so excess servicing is defined as rights to receive amount in excess of reasonable compensation for services. So kind of in my example, to the extent that you're receiving something in excess of that reasonable compensation, you have what we refer to as excess servicing. And excess servicing is considered a stripped coupon under the rules, which is defined in 1286 of the Internal Revenue Code as a coupon relating to a stripped bond. And a stripped bond is defined right there as a bond issued with interest coupons that have separate ownership. So in the case of an MSR, likely the loan has been sold, but a portion of the interest payment has been retained as that fee income on the MSR. And so under these rules, you've sold the stripped bond, you've retained a stripped coupon, and then there's specific tax rules about how that gets treated. So kind of in my previous example, if you had a conventional loan with 20, normally the safe harbor is 25 basis points. If you were getting 30, then potentially you would have 5 basis points of excess servicing that would need to get valued and treated separately or differently than the normal servicing component. So as you can see in that final bullet point, the fair market value of the stripped coupons must be determined and recognized for tax purposes. This creates tax basis in the coupons, and they can be amortized using some relatively complex OID rules under Section 1286 of the Internal Revenue Code. So that'll become a little bit clearer, I think, on this next slide as we kind of talk through the income. Oh, sorry, forgot to move the slide along. So normal servicing, the income is recognized as a servicing fee as it's accrued or received. So, typical accrual basis taxpayer, if that income is accruable, then that's when it's recognized for tax purposes. So what does this mean from, a book tax difference? I kind of outline it a little bit further down here on the slide. The initial fair value that gets recorded for GAAP purposes on these MSRs, to the extent that that's attributable to normal servicing, that income is not going to be recognized for tax. We get to reverse that fair value adjustment out for tax purposes, and we only have to recognize income to the extent of normal servicing. We only have to recognize it as fee income as it's accrued for GAAP and tax purposes. The excess servicing component is a little bit different. That's more consistent with the gap treatment. So to the extent you do have excess servicing, you do have to recognize income for that initial, fair market value of the stripped coupon, and then obviously the servicing fee, that you're collecting along the way also gets recorded and recognized as income. So that's very similar to the gap treatment with respect to excess servicing. I don't want to focus too much on excess servicing today, actually, because, for the most part, taxpayers, or at least our clients that we've been working with, there's typically not much excess servicing, if any, kind of embedded in the portfolio. I would say that, most contracts, you're either kind of getting that safe harbor rate or something less. There are obviously instances where people might be getting more than those safe harbor rates. And, to the extent they are, we probably need to, take a closer look and determine whether or not there is some excess servicing there. But I'm not going to focus too much on excess servicing just because it's typically not much of an issue for the clients that we're dealing with. So, anyway, to kind of outline how the income gets recognized for normal and excess servicing, and then the book tax differences. So the first one I mentioned was that to the extent it's normal servicing, you have this initial fair value that gets recorded for GAAP purposes, but it will not be recognized for tax purposes. And then any periodic fair value adjustments, including impairment or any amortization that gets recorded for GAAP purposes on that normal servicing component, will also not be recognized for tax purposes, because obviously by reversing off the initial fair value, there's no tax basis embedded in this asset like there is for GAAP purposes. And then that last bullet point is just the difference in the GAAP amortization versus the tax amortization related to excess servicing. So to the extent, again, you have excess servicing, you are going to have tax basis in that asset because you did have to record that initial fair value, and that will get amortized both for GAAP and tax, although the amortization periods and methodologies might be different, which could result in a book tax difference. So that is kind of, I just wanted to start off the presentation by having this quick outline of these concepts of normal versus excess servicing, because they somewhat come into play when we start talking about the bulk sale of MSRs as well. So. Just wanted to throw a quick slide in here about purchase mortgage servicing rights, because it's slightly different than the normal and excess servicing components, which refer to originated mortgage servicing rights. So to the extent that you actually go out and buy MSRs, that since you're actually paying something for those up front, that would create tax basis. So we would record tax basis for the purchase price of the MSRs. And then there's a couple of different ways that those can get amortized. So the first is if all you do is go out and buy MSRs, so your entire acquisition consists just entirely of MSRs, then it's 108 months. And that's some rules under Section 167 of the Internal Revenue Code about how those would get amortized. If you buy MSRs as part of the acquisition of a trade or business, then the MSR is actually considered what we call a Section 197 intangible asset, and that amortization period would fall under those rules in Section 197 of the Internal Revenue Code, and those rules state that it would be a 180-month period over which those would get amortized. So again, don't want to focus too much on PMSRs because probably most of you are not engaged in going out and buying MSRs, but at least just wanted to make you aware of those rules. So the tax accounting method change, mentioned at the opening that there is a procedure that allows taxpayers who are not treating their MSRs appropriately to file a request with the Internal Revenue Service to change their method of accounting with respect to MSRs to be consistent with the methodology that's outlined in Revenue Ruling 9146. And all that is basically this normal versus excess servicing component. So, sometimes what we'll see is we might, get a new client and they have mortgage servicing rights that they were recording on their GAAP financials at fair value, and they had no book tax difference, historically to reverse those off. And so that would be a method that's inconsistent with this revenue ruling, and this method change would allow a taxpayer to send a request to the IRS so that they could start treating their MSRs in a manner that is consistent with those rules. Now, a couple of nuances. And that request is done on Form 3115. That's why that's in there. Again, not getting the slide. So that's kind of what I was just talking through. The method change, if it's applied for, is done on a cutoff basis, and all that means is that when you can only apply the method to the MSRs that are originated in the year of change and subsequent years. So if you file this method change request with the IRS, let's say for 2015, then the year of change would be 2015. You would be able to apply the methodology on all MSRs that are originated in 2015 and forward. Any MSRs that were originated in prior years and a different methodology was used to account for those from a tax perspective, you would have to continue to use that methodology on the old MSRs. This is an advance consent request. What that means is there's two ways that you can send requests to the IRS. One is what we refer to as an automatic change, and those are just listed changes. There's just a list of changes out there that method changes that that taxpayers can just automatically change to. They still have to file 3115, but they have the ability to just automatically change to it without getting written acceptance from the IRS. When you have an advanced consent change like we do here, there's generally a user fee associated with it, first of all, which is currently $8,600. And then you also have, the taxpayer also has to wait for written acceptance from the IRS before adopting the new method. So it's not one where they can just automatically change to the new method. They have to send this request in. The IRS has to write back and say, yes, we agree that you can adopt this new method, and feel free to adopt it as of 1/1/2015 in my example and forward. So you have to kind of wait for that process to complete before adopting the new method. The due date for filing this 3115 is just the due date for the tax return for the year of change, including extensions. So that's a little unusual because most advanced consent requests actually require you to file it in the year of change. So if you wanted a method change done for 2015, you'd have to file it sometime in 2015. In this case, you can actually wait until the extended due date of the return. So you would have, if you want the method change to apply to the 2015 tax year, you would have until potentially maybe September 15th of 2016 to file the request. And then lastly, there are some special rules that are out there for taxpayers that are under exam or before an appeals office or in federal court. So if you're in that situation, there's just some special rules that we would need to work through to make sure that the method change is getting filed properly. All right, now we'll move on to kind of the big topic of the day, which is the bulk sale of MSRs. So I would say probably over the last couple of years at least, our firm has really done some pretty intense research in this area to try and determine whether or not there's a position that taxpayers can take to treat the sale of MSRs as the sale of a capital asset and therefore get some capital gain treatment. And kind of what we've determined in that intensive process is that there's really not much guidance in this area, unfortunately, and most of the guidance is somewhat outdated. So I see there on the slide we mentioned some court cases from the Fifth Circuit. Those court cases date back to the 1960s. So, and back in those days, the economics around MSRs was drastically different than what it is today. With the economies of scale and the technology that's available to us now, the servicing fees and the economics kind of around these transactions were substantially different than what we're seeing today. So while those court cases certainly give us some ideas to how the courts kind of view this, you know, the fact that it's outdated also has to kind of be considered as well. There is a little bit more recent IRS guidance in this area. You know, there's an FSA, which stands for Field Service Advice, that was issued, I think, in the early 90s. I want to say it's 92. That gives us a little bit more guidance on this, but, you know, even that we're talking 20 plus years ago. So there's just not a ton of recent guidance that, you know, helps us to get, you know, extremely comfortable one way or the other as to how these bulk sales might be treated. But with that said, we do feel that there is enough guidance and literature out there that our firm has concluded that, you know, taxpayers may take the position that some portion of the purchase price of these MSRs is attributable to what we would call either goodwill or a strip coupon, and, you know, that portion of the asset can be treated as a sale of a capital asset and result in capital gain treatment. And I'll get into more details as to kind of how that works. But we feel that at least some portion of this probably is a capital asset, and we can get some favorable tax treatment under the rules. All right, not very good at progressing these slides. So that's kind of what I was just walking through right there is our conclusion on this position. The riskiness of the position, again, because there is such limited guidance here, this is really a gray area. You know, we do feel that there is enough kind of guidance and authority out there that we can get to a position that what we refer to in the tax, you know, in tax lingo as substantial authority. And all that really means is, you know, a lot of commentators kind of put, that means there's kind of maybe a 40% chance or so of success just based on the merits of the position with all the guidance and literature that was available, you know, kind of weighing all that authority. You know, we feel that there's somewhere maybe around 40% chance of success should the position be examined by the IRS. The reason that that's important is because substantial authority is really kind of the baseline threshold for filing positions on tax returns without disclosure. So the fact that we could get to that level gave, you know, a lot of our clients comfort that we can take this position on a tax return and there's no requirement to disclose the position in the return to the IRS because we're at that level. If we were at a lower level, which I refer to in my slide here as reasonable basis, and the reasonable basis is kind of commentators would say maybe a 1 in 3 chance of success, or about a 33% chance of success. If we were down at that level with respect to this position, then that changes that disclosure requirement. So, you know, if we take a position on a tax return as a tax preparer, if we want to take a position on a return that only has a reasonable basis position associated with it, then in order for us to kind of sign and prepare that return as a preparer, we would require that a disclosure be included in the return. That disclosure is done on Form 8275, and basically all you would do is outline kind of the position that you're taking and why you think, you know, you would kind of outline both the good and bad facts associated with the position, you know, to the IRS. Now, you know, a lot of people get really squirrely or concerned about including a disclosure form in the tax return. But, you know, our experience has been, I mean, we've filed quite a few of these 8275s. I'm not sure that I can think of an examination that's resulted as a result of including an 8275 in a return. But certainly if a return gets examined and it has an 8275 in it, you would think that that would be the first place that the IRS would start looking. And then, you know, we'd have to kind of fight about the position. So that's where that substantial authority really kind of gives us some good benefit is there's no requirement that we disclose in the return. Now I say here, certainly if a taxpayer is concerned about this 20% penalty, which could be at play if the IRS were to try and contend that you did not have substantial authority with the position and that you took the position on a return, then there's the possibility that they could assess a 20% penalty. And so if a taxpayer wants to be, more conservative and make sure that that 20% penalty is off the table, they can include this disclosure. And by including the disclosure, the IRS cannot assess the 20% penalty. So that's just kind of put some color around, the riskiness of this position. We feel fairly confident that this idea of kind of bifurcating the value between kind of an ordinary income component and a capital gain component definitely has some merits. I mean, the literature out there and all the IRS guidance seems to point in that direction. So I think we feel pretty good about it, but it's certainly not a slam dunk, and there's definitely some grayness to this position that needs to be considered when a taxpayer wants to take it on a return. So just to kind of outline our overall position here, the gain on the sale of MSRs could potentially be bifurcated into 3 different components, and that's this FSA that I was referring to earlier, field service advice. It talks about these 3 components, and so does some of the other court cases and things that I mentioned earlier. So the 3 components are as follows. The first is a compensatory portion that represents the present value of reasonable compensation the servicer is expected to receive. So that sounds a lot like normal servicing, and that's why I want to kind of talk about that normal servicing component up front, is because when you talk about this compensatory portion that represents reasonable compensation, that's what it sounds like. Now, we feel that you can make an argument that while the safe harbor, for example, might be 25 basis points for normal servicing, kind of on the back end when you're selling these things, we feel that there's definitely an argument that can be made that reasonable service or that reasonable compensation component of the value that's being sold could be something less than that. And we've actually worked with some of our clients to get it significantly less than that. And the reason that's important is because this compensatory portion is the piece that is going to be taxed at ordinary income tax rates. So to the extent we can get the value of that to be lower in the valuation of this portfolio of MSRs, that would result in less ordinary income and potentially more capital gains. And to the extent those are long-term capital gains, there's a significant tax savings that's associated with that I'll talk about here in just a couple of minutes. The second portion that we need to value is that strip coupon. So that sounds a lot like excess servicing. And again, I think we would say to the extent you have excess servicing when you originate the MSR, you certainly have excess servicing on the back end when you sell it. So we have to kind of weigh the tax consequences of what that might mean as far as how that would get treated. Again, if you have excess servicing, then you've got tax basis in that excess servicing to the extent you haven't amortized it fully off. And so there may be little or no gain associated with it, and especially, like I said, since in most cases the excess servicing is a small piece or there's no excess servicing associated with the portfolio, typically this piece tends to be pretty small and the gain associated with it tends to be pretty small. So again, I'm not going to go into too much detail on this strip coupon piece, but just wanted to make you aware that should be considered when valuing a portfolio. And then the last piece is what we would call goodwill. So most of the time, if we don't have to deal with excess servicing, most of the time what we're trying to do is just figure out the value of this reasonable compensation component, and if we can figure out the value of that piece, then any remaining purchase price in this deal we would consider goodwill for the most part. And the reason that that's good is because goodwill is definitely a capital asset and gets treated and gets taxed at capital gains rates. So again, potential savings, significant savings there. To the extent we can get the value of that reasonable compensation piece down and get the value of the goodwill up, there's an opportunity to pick up some pretty decent savings by using capital gains rates. So that's what I outlined here is just the compensatory portion will result in ordinary income. The strip coupon may result in capital gains. We think for the most part it should be capital gains. but I guess there is an argument that could be made that it should be ordinary to the extent that you think it has to be classified as a security under the code and mark to market. But I don't want to get into too much detail there. It's probably beyond this presentation, but we think it's capital gain, but there might be an argument to treat it as ordinary income. Again, most cases this is probably a very small or zero effect on the portfolio that's being sold. And then lastly, the gain, again, attributable to goodwill is definitely capital gain. So the benefits of capital gains, again, there's an ordinary income component to this. That ordinary income will be taxed at ordinary rates, which are currently as high as 39.6% for federal purposes, and then obviously layer on the state tax consequences on top of that. So that would be the compensatory portion, which would certainly be taxed at those rates. Then the short-term capital gains, which would be the disposition of capital assets held for 1 year or less. Those would be taxed at ordinary rates as well, which again are 39.6%. However, if you have short-term capital gains, you may be able to use those to offset other capital losses that you had from disposition of capital assets. So if you had other investment type assets or other things that were generating capital losses, even though you don't get a beneficial rate from the short-term capital gains, you may be able to use those to offset those losses, or you may be able to offset those gains with losses that you have incurred from other disposition of the capital assets. And then the long-term capital gain is obviously the one that we're shooting for here, because that's the disposition of capital assets held for more than 1 year, and those get taxed at capital gains rates, which are either 15 or 20%, depending on your income tax rate bracket. So, as I kind of point out here, the potential savings could be 20%. So if we're able to take a fairly sizable portion of this portfolio that we're selling and get it to be considered that goodwill component in our valuation, then we could potentially save here 20% on those in tax savings just by being able to treat that as a capital asset, subject to the capital gains rates. So that's really kind of what we're trying to do with this process, is we're trying to value this portfolio that we're selling, and in such a way that this reasonable compensation component is valued as low as possible, thereby maximizing the goodwill component, and therefore being able to save 20% on taxes here. So lastly is really just kind of our recommendations. Consult with us or another qualified tax advisor regarding kind of your specific situation. Every portfolio may kind of have some uniqueness to it, some interesting characteristics that are kind of built into the portfolio that may or may not have an impact as to how we approach the valuation of it. So always want to consider the specific fact pattern that you might be dealing with. Secondly, analyze and document your specific facts, circumstances, determine the tax reporting position. So, what we're really getting at here is, this valuation process really has some flexibility to it, because, in valuing the portfolio, obviously, you go to 10 different evaluators, you're going to get 10 different answers. And with the number of assumptions and things that go into the valuation process, there's obviously lots of ways to kind of slice the apple here. So what this is really kind of getting at is, can we analyze, document our specific facts? Can we analyze how we're going to approach the valuation? And how aggressive are we going to be in the valuation? Are we going to value that reasonable compensation component at a very low level to try and maximize the capital gains, or do we want to be a little bit more conservative so that if the IRS comes calling, maybe we don't have to fight with them as much about what that reasonable compensation component should be versus what the goodwill component should be. So again, that's kind of what that step involves. Third, kind of get a third-party valuation of the MSR portfolio prior to the sale. I mean, we say prior to the sale, we just want to make sure that it's a valuation as of the date of the sale. You don't have to necessarily get the value. I mean, I think the closer to the actual sale event you get that valuation, that's probably better facts should the IRS come calling. But we just want to make sure that the valuation, whenever it's done, is a valuation that is calculated as of the date of that sale. And that evaluation needs to separately kind of state the value of that reasonable compensation component. So again, it's about what are the assumptions that go into that valuation that will allow us to drive down the value of that reasonable compensation component. And working with a third-party valuation expert, you can kind of work through that process. And then last is, there might be some third-party experts out there. We know of one who's helped out several of our clients as far as kind of identifying the approach that you want to take with the valuation and documenting the reasonableness of that valuation, including the assumptions used. We just think having that documentation in place goes a long way should the IRS examine your return. Having that documentation in place and it's contemporary with the sale and with the valuation, it just kind of outlines to the IRS why we did what we did, why we think it's a reasonable approach, and why we think the valuation is solid and good under the facts and circumstances under which we're selling. So again, if you're interested in that, we know of at least one resource that can help in that area, and I'm sure there's others out there that could provide a similar service, at a fairly reasonable cost, especially with these portfolios. A lot of these portfolios are being sold, and we're talking about millions of dollars, and incurring some fees in this consulting area to kind of make sure you document this as well as possible may go a long way. Again, should the IRS decide to examine your return. So those are some of our recommendations in this area, and that's really all I got. Looking at the questions, I don't think there's any questions in there right now that I see. Again, if you have any questions after the webinar, certainly feel free to email me. I've got my contact information on there, phone number and email. I'd happily respond to any email questions you might have, or feel free to give me a call if you want to talk through anything that we discussed on the webinar this afternoon. With that, I hope you found it valuable. I hope this gave you some good insight into the world of MSRs from a tax perspective, and that, again, you found some value in participating in our webinar today. And I appreciate your time. And with that, I'll turn it back over to Kurt for some closing remarks.
All right. Well, thanks everyone for attending today's webinar. Like Jared said, hope you found it valuable. I also want to thank Jared for presenting today. We'll wait a couple more minutes just to see if some questions pop in. But just to let you know, if you do have a question after the fact, feel free to reach out to us, and we'll get back to you or request additional information if we're unable to answer it based on the information received. We're always trying to provide topics that are timely in today's environment and informative, and so we welcome your ideas for future topics for webinars. So if you do have some ideas or some areas that you'd like to see covered, please email us at info@richeymay.com, and we'll take those into consideration for future webinars. Finally, just to let you guys know again that we will be posting the webinar to our website, as well as emailing the PowerPoint slides out to all the participants today. So,
no questions.
Yeah, so it looks like no questions have come in. So again, thanks everyone, and we'll conclude the webinar.
Have a good day.